Barry, we've been talking a lot here at Bloomberg about how rent is the last domino to fall, shelter costs. When we think about the inflation story, how sticky is higher shelter costs?
Extremely. If you think about the various measures of rent, the apartment list, which is new rents, or the Zillow Observed, which is more of a blended of existing and new rents, they peaked in mid 2022. Most of the academic research says that it should be about a year lag before it filters into the CPI or PCED measures. Well, here we are, nearly 2 years past, and sure, it's come off, but we've lapped the 7 month period where we were averaging something close to 0.75 per month in the core rent of shelter measure. And it still hasn't moved down all that much below 6%. And if you look at those measures on a quarterly basis, they've turned back up along with house prices. So it's very unclear to me that we are going to get anywhere near the 0.25 monthly increases or 3% annualized increase that persisted through the 2010s. I think the Fed did serious damage to the housing market. They exacerbated the structural imbalance by the way that they tightened. Passive QT and aggressive rate hikes caused the deepest yield curve inversion since the Volcker era. So they damaged the supply side just as much as they damaged the demand side, and just made things worse. So for me, I don't think that it's plausible to get to 2.5. And I would further go on to say that Kashkari's expectation that the Fed alone can bring inflation to 2% is not consistent with history, not consistent with the 60s or 70s. We would need a tightening of fiscal policy to bring that non-housing services component down, which is reaccelerated in the second half of last year. So I'm not nearly as sanguine about the inflation outlook as President Kashkari, that's for sure.
Skylar, what is your expectation here? We're just days away from another critical inflation print, and where are you the most concerned that we can still see things too high?
Yeah, I mean, I completely understand the worries over sticky inflation. On the good side, it's been very evident that we keep getting these rises in commodity prices, even if they've moderated in more recent trading. We have continued global political tensions, so geopolitics have, definitely been in the background, and that's meant continued shipping disruptions, and both of those things automatically feed into headline inflation. I think the bigger worry, because of the potential for second round effects, is on the services side. Wages are, fairly sticky in the 4 to 5% range, depending on what measures you're looking at. And because we've had 3 months of a row in upside inflation surprises, it's harder to get that downside surprise. But what I will say is that in the U.S., there's been a supply side rebuild. So the labor market has rebalanced with job openings declining in the industries that had the highest vacancies. And I don't think higher wage growth necessarily has to be inconsistent with disinflation if productivity is rising. So I think for us, 1Q was very much a bump on the road of disinflation. I don't think we settle back at 2%. That seems more unrealistic, but certainly we could get some downside surprises in inflation from here.